Alright traders, I wanted to point out a high time frame chart I just got involved with. This one went out to the insiders, of course, and this is a bat pattern coming down into the 886. As you can see, we barely got filled here. I mean, it was a very nice. If this ends up being the turning point here, this is a very nice area where this market is set to turn, because this bat pattern is going to complete right here, and we should see a pretty significant rally out of the euro yen here, which is kind of funny considering the current situation in the eurozone. But even with those, that being what it is, this is another example of you trade the pattern when the pattern comes, and you put yourself in a position to be able to to make a profit when the market provides you with an opportunity. And if you're going to be an advanced pattern trader, what I call an advanced pattern trader, this is something that you have got to be willing to do, which is to go against the grain at times and what is happening in the world and what the news events and all of that are saying and telling you that you ought to be doing. This pattern formation here is a perfect butterfly pattern here, completing at the 886 retracement. And I want to go ahead and drop this down to a 60-minute chart. And I'm going to actually show you what we're looking at here on the lower time frame. Now there's some framing here that has happened. If you look at the bottom, we talk about stop moving and when you want to be able to move your stops. And in a situation like this, what I tend to do is, if you look, I'm going to collapse this chart way up so you can see where the stops are all the way down here, significant distance away right now, because I didn't know at the time where this market was going to turn. I thought we were probably going to find some support right around this 886 retracement, and as it turns out, we have. Now the market has rallied significantly and sharply off of that, from about 108.04, which is where we got involved, to 109.30. So over 120 pips in a very short amount of time here on this particular trade. Now, what I'm watching here is this, and it's not this high. It's not the spike high that you might anticipate it would be, but it's the initial high of the channel. If you look at this channel, I'm going to draw in the channel from the absolute high to the low end here. If you take a look at this, there's a channel in here, and if I collapse this down, you're going to see even more specifically what I mean by this. Alright, now this is the initial low, the lowest low, the initial low, and then this is the initial high of the channel. And as you can see, guys, we have broken through these lows many times, but we've never closed above or below them. And so that defines for me where my channel needs to go. So I go ahead and draw this in, and I say bump, and I say bump. Now, once I've defined my area here, where my highs and my lows that have yet to be penetrated inside the channel, what I can do is what I need to wait for is I need to wait for a break above, close above. I need this market to rally up, and not only rally up here, but close above this 109.37 area. When that happens, I can move these stops up, because now I've created a base that's been broken. And now I can significantly decrease my risk by raising my stops up to underneath these, what are essentially triple bottoms. But until that happens, I have to leave them where they're at, and I have to risk the market may break down and stop me out. And that's why when we talk about these things, guys, back out on the daily chart now, when we talk about this stuff, guys, you look at this and you say, well, do I accept this risk? And this is where you can put all the fear and greed aside, because if you are looking at this trade and you understand, look, this is a trade on the daily chart. And what that means is that I'm going to have to accept more risk. So what can I do? I can either accept more risk, or I can, if I've chosen the right account for my account size, I can choose to dial back my position sizing on this particular trade in order to account for the extra stop loss that I'm going to have in there. But I want to make sure that I'm not overexposing myself in the market, and the best way to do that is to dial back the position sizing, because you want to be able to take advantage of these. This is a longer term swing trade. If we're looking at it on the daily chart, even if we get significant rallies here, it's going to take 1, 2, 3, probably 4 or 5 days to get back up here to to where our initial targets will be. And so we're going to be looking at holding this for a week, holding it over a weekend. Those types of things are all things that you have to consider when you're putting the risk on. But if you're willing to take that amount of risk, if you have looked at it and you say, yes, given the potential reward, given the pattern setup, given my position sizing, I am willing to accept this much risk, then being able to roll your stops is simply a bonus. This market can, if I look left over here to X, where my X is, this market can come all the way down to X and stop us out. Or, excuse me, and come all the way back down here and rally and still be a valid Gartley pattern. So what we have to do is we have to have our stops below X. And as I look left, I also see that there is another cycle bottom in here that the market may try and aim for in order to take out the stops of anybody watching these lows. And so what I did was I took the low of that area and I went just underneath it. Now, if this market continues to rally here, then that's going to be great. I will feel no pain. I will roll my stops up underneath the triple bottoms and hopefully just stay behind the market as it rallies. If, however, it rolls over and takes me out on my protective stop, I have accepted the risk of that stop before I put the trade on. Before this trade went on, I knew 3 things. I knew where I was entering the market. I knew where my stop was going, and I knew where my initial target was. I knew that the risk-reward profile was good enough to take the trade, and I knew that my risk exposure, because I could dial my position sizing back, was not so much that I would be putting my account at risk if I got stopped out. And so those are the types of things, as you start to think through your own trading and the decisions that you have to make as the trader, those are the things that you have to consider. Those are the checks that you need to put in your boxes in order to make sure that you're in a trade that you should be in. Too many traders come into the market and they just start trading. They just start throwing money around. They're like, oh yeah, that looks like a good trade. Oh, it's a double bottom. Oh yeah, I know that. Oh, there's a head and shoulders pattern. Oh yeah, I'm going to go ahead and trade that. And then once they put the trade on, now they're trying to figure out, okay, I'm just going to let this run and see what happens. And then when the market starts to go against them, then they start to ask questions like, should I be in this trade? Where should my stop go? When should I get out? The most painful emails that I get are from traders who tell me, I took a long trade, I took a short position, whatever the case may be, I'm now down 200 pips. And I'm not sure whether I should stay in the trade or get out. What should I do? And that immediately tells me that that trader had no plan when they entered the market. When that trader got involved in the market, he or she had absolutely no idea when and how they were getting out. They had no safety net. They intended to take the trade and then, watch it go into the green and then decide once it was in the green when they were going to take their profits off. And traders, that is a self-destructive way to trade. 3 things: entry, stop, and target. Where am I getting in? Where am I getting out when I know I'm wrong? And there are conditions that we apply to determine when we're wrong. How do we know when we're wrong? How do we know when we need to be out? But once I know that, where am I getting out? And number 2, where are my profit targets going? And how do I identify that? How do I determine the right place? Because it's not arbitrary. Nothing that we do is arbitrary. All of it has a purpose. There's specific reasons why every single engagement with the market happens. And traders, I would, in a last note, I would say to you, if for any reason you don't know those things, and you don't have that trading plan laid out, and you don't have that information ready at hand, stop trading immediately. Go back to the basics, go back to the beginning, and start writing those things out so that you can empower yourself, so you can provide yourself that level of security and comfort when it comes to putting these trades on. I don't know whether this trade will be a winner or a loser. In the grand scheme of things, it doesn't matter. It's just another trade. But I can tell you, traders, that if you don't have the plan, then you're going to lack the confidence. And if you lack the confidence, you're going to lack discipline. And if you lack the discipline, then ultimately you're going to fail in your attempts to conquer the market. Until next time, guys, good luck and good trading. My name is Jason with Triple Threat Trading.